Welcome to the deep dive. If you're keeping an eye on electric vehicles, critical minerals, or frankly just global supply chain risk, then you know all roads seem to lead through the Democratic Republic of Congo, the DRC. And right now, that road is getting extremely bumpy. Today, we're zeroing in on cobalt. It's that vital ingredient, the one that helps power most of the high energy density batteries we rely on. Our mission. It's laser focused. We need to unpack this recent, really dramatic policy pivot by the DRC. First, there was that sudden export ban, and now it's being followed by this complex quota system. We want to cut through the noise for you and show exactly who wins and who loses across the whole global supply chain. We're talking from the miners, digging in the copper belt, all the way to the big EV manufacturers in places like Germany and the US.
Yeah, and this is really more than just another piece of mineral news. Understanding this shift, this move from an outright ban to a controlled quota system, it's essential knowledge right now. It fundamentally shapes price expectations, it dictates supply chain risk, and it really reveals where the true strategic leverage lies in the battery metal sector for, well, probably the next 5 years at least. The rules of the game just changed dramatically. And if you don't adjust your strategy, you're definitely going to feel the pinch in procurement.
Okay, so let's jump right into that policy shift itself, because it happened pretty fast, didn't it? Earlier in 2025, the first move was a real shockwave. The DRC slapped on a multi-month, what seemed like an indefinite export ban on cobalt, and they weren't subtle about it. Their stated reason for the ban was almost textbook economics. They argued, look, we need to counter this recent oversupply that had really pushed down global cobalt prices. So they effectively just turned off the tap to try and force a global price correction.
Exactly. They were essentially saying, we're not going to keep selling our critical raw material cheaply anymore.
Right.
And that's a pretty clear example of resource nationalism, which, let's be honest, is the underlying theme here. But, as we often see, policies demanding a complete stop and outright cessation, they're often quite difficult to maintain long term. So starting October 16th, that total ban is being replaced by this highly regulated quota system. And that move, that's the key thing. It shifts the DRC from a sort of temporary shutoff strategy to, well, a much more sustainable long-term control strategy. Yeah. And what's really fascinating here is getting under the hood of the true policy driver. The DRC isn't just looking for, slightly better prices today. They seem to be executing a broader value retention strategy.
Value retention, meaning?
Meaning they want to control the export flows to hit two big long-term goals. First, they really want to spur significant local refining investment inside the DRC, get more value add onshore.
Oh, okay.
And second, they want to be able to negotiate much stronger, more favorable terms with the major foreign investors, the ones who absolutely rely on access to their cobalt.
So moving from that blunt instrument, the total ban, to this more, let's call it surgical tool, the quota system.
Yeah.
That's a massive strategic upgrade for them, isn't it? It's like saying we aren't just disrupting the market temporarily, we are restructuring it potentially permanently.
Precisely. That pivot from just being a pure supplier who ships raw stuff when asked to becoming a controller who actively manages the flow.
Yeah.
That's a huge signal to the entire global mining community.
Yeah.
It tells every global company, look, you need to align your strategies with the DRC's national interest if you want continued access to the world's single largest cobalt supply. It's really a geopolitical power play, just expressed through mineral policy.
And that power play, it had immediate, very measurable consequences in the market, right? Even before these quotas fully kicked in, that initial ban, it took tens of thousands of tons of supply off the market, enough to make analysts everywhere sit up and really take notice.
Oh, absolutely.
And taking that amount of cobalt off the table, well, it did exactly what the DRC likely intended. It immediately pushed existing global inventories lower. And maybe more importantly for the futures markets, it puts significant sustained upward pressure on cobalt spot prices. It's, basic supply and demand, but when you apply it to a strategic metal like this, the ripples are enormous.
And the potential for tightening is really the story going forward. For months, analysts had been projecting a cobalt market that was, frankly, heading into a pretty comfortable surplus. Now, though, if these government restrictions persist, and the complexity of this quota system suggests they absolutely will,
right,
that market could flip and flip rapidly. We're now talking seriously about potential multi-year deficit territory.
Wow, deficit.
And this is critically important if you're a procurement specialist listening right now. You're no longer just dealing with, a normal market supply-demand imbalances. you're operating in an environment where supply tightening isn't just a commercial risk. It's actually a core governmental policy objective from the dominant supplier.
That changes everything.
It forces every single downstream buyer to immediately rethink their long-term hedging strategies, their inventory requirements, their ability to even secure multi-year contracts at rates they can predict. It introduces a huge amount of uncertainty.
Okay, so if the DRC is effectively holding the cards now and deciding who gets how much cobalt, let's unpack this. Who's getting burned immediately and who might actually be benefiting from this kind of enforced scarcity across the global supply chain? Let's try and map out that global scorecard.
Well, the clear winners, initially at least, seem to be those who either sit outside the DRC's direct control or those who might benefit directly from the policy itself. So at the national level, other countries with alternate cobalt deposits, they're looking like massive winners right now.
Okay, like who?
Indonesia specifically is mentioned in the source material as gaining really significant leverage from this situation.
Indonesia. Why them in particular?
Well, Indonesia produces cobalt mainly as a nickel co-product, primarily through that HPL high-pressure acid leaching technology, which is scaling up quite rapidly, actually. Now, their costs might currently be higher than traditional DRC mining. But this DRC policy shift suddenly makes Indonesian supply look instantly more reliable, more politically stable, and therefore more commercially attractive. When DRC supply becomes constrained by policy, Indonesian supply becomes strategically vital almost overnight.
That makes a lot of sense. But I guess the question is, how quickly can Indonesia realistically scale up production to fill a potential global deficit if the DRC really keeps its thumb on the scale? I mean, aren't there still significant challenges around permitting, environmental concerns with HPL?
Oh, absolutely. That's the key challenge, you're right. Indonesia offers diversification, a crucial alternative, but it's not immediate like-for-like parity with the DRC's volume. Not yet, anyway. However, what the DRC's restrictions are doing is forcing the market, forcing investment to accelerate into those alternative sources like Indonesia.
So it kind of becomes a self-fulfilling prophecy for diversification.
Exactly. It speeds up that transition. We also see potential wins for certain downstream players who are maybe prepared or had foresight. Firms that already locked in pre-agreed long-term sales contracts, what we call offtake contracts. They could benefit significantly from scarcity premiums as spot market prices climb way above their secured rates.
Yeah.
They secured price and volume when maybe others didn't.
Smart move for them. And we shouldn't forget the DRC itself in the winners column, right? I mean, if this policy actually works as intended and pushes for more domestic processing, they capture that added value from refining the metal within their own borders instead of just shipping out raw ore. That's potentially a huge economic win for the nation long term.
A very significant potential win, yes.
Okay, so flipping that coin then. The losers list seems heavily weighted towards the demand side of the equation. The big battery makers, the massive EV manufacturers, they seem squarely in the crosshairs here.
They really are. They're facing this sort of compounding problem. First, cost inflation, which obviously hits their margins hard. And second, severely increased supply risk, which really complicates their ambitious plans to rapidly scale up EV production globally.
Yeah, I mean, you can imagine the meetings.
Exactly. And let's get specific on that impact because it's genuinely concerning for companies that maybe rely on fixed price procurement contracts or just assume stable supply. Suddenly, they see their primary long-term supply source subject to, well, unpredictable political decisions. That kind of volatility can destroy forecastability for a business.
Absolutely. Then you mentioned smaller miners?
Yes, the smaller or more marginal cobalt miners, maybe operating outside whatever the new quota allocation ends up being, they could get squeezed out entirely. And finally, don't forget certain trading firms and financiers. Those that relied heavily on simple arbitrage opportunities or maybe predictable trade flows based on stockpiling. Their models are taking a severe hit as the whole market structure fundamentally changes under this government control.
So the entire trading ecosystem has to adapt to this idea of managed scarcity.
It really does. Now, let's maybe dive into the complexity of this new quota system itself, because it's not just, a simple percentage cut across the board. Implementing this involves balancing multiple, often conflicting variables.
Right.
Allocating the quotas, enforcing them, deciding who's even eligible. These are extremely complex processes. The DRC government has to somehow balance things like a company's past export history against potentially new requirements for local content, meaning how much processing value they add locally.
Mm.
And then there are the existing, let's say, diplomatic or commercial relationships with major international buyers. It's like a multivariable puzzle they have to solve to make this work without crashing their own mining economy in the process.
So professionals watching this space, what are they looking at most closely? The design of the quota itself must be key. We need to know. Is it going to favor the massive established producers who've been there for decades? Or is it perhaps designed specifically to reward firms, maybe even newer ones, who commit to significant downstream refining investment in the DRC? That choice tells you a lot about the real long-term goal.
Absolutely. That design is crucial.
And then there's enforcement. How rigidly, and maybe just as importantly, how transparently will these quotas actually be applied? And critically, coming back to Indonesia and others, how quickly can those alternative sources really scale their operations to become true competitors? Because that speed, that dictates the DRC's maximum leverage, doesn't it?
It absolutely dictates the timeline and the leverage. And that brings us neatly to what I think is the ultimate strategic risk for the DRC's policy. And here's where it gets, well, really interesting. This is the potential boomerang effect of over-controlling the market.
The boomerang effect. Okay.
Yeah, think of it like this. The DRC is holding a remote control for the global cobalt market, right? And they're aiming to turn up the volume, meaning the price and the value they capture.
Makes sense.
But if they hit that volume button too hard or too unpredictably, everyone else in the room starts investing very heavily in noise-canceling headphones.
Okay, good analogy. And those noise-canceling headphones are cobalt substitution.
Exactly, cobalt substitution. If these quotas end up being too draconian or too unpredictable or just make cobalt too expensive for buyers long-term, it will absolutely accelerate global R&D efforts toward finding ways around it, pushing faster into battery chemistries like LFP, lithium iron phosphate, or those high-nickel cathode versions that use much less or even zero cobalt.
Right, or even boosting recycling efforts much faster.
Or boosting recycling, precisely. The DRC has to strike this incredibly delicate strategic balance. They want to gain maximum value and control right now, understandably. But they can't push the market so hard or so fast that they dramatically accelerate the timeline for technologies that eventually render their main resource, cobalt, well, non-critical or at least less critical.
That is the ultimate tightrope walk, isn't it? Maximize your profit and control right up until the moment the world figures out how to leave you behind. So just to recap our deep dive here. This cobalt policy shift in the DRC, it's rapidly becoming perhaps the single most critical leverage point in the whole critical minerals race. It's fundamentally reshaping the risk profile, the strategic positioning for investors, for manufacturers, really across the entire globe. The era of just simple, unrestricted raw material flow might be definitively over for cobalt.
I think that's fair to say. And that leads us right to the final thought we want to leave you, the listener, with building directly on that substitution risk we just talked about. And the DRC is, quite really from their perspective, flexing its muscles as a market controller right now. They're trying to secure better terms, higher value for their citizens and their resource. But the big question is, if that control pushes the market too aggressively towards cobalt-free alternatives, how quickly might that hard-won leverage actually disappear? What stands out to you as the most viable long-term strategy here? Is it maximum control and forced scarcity to drive high short-term value? Or is it ensuring maybe more supply diversity and reliability to maintain cobalt's long-term relevance in the battery space?
A question that could define the profitability and maybe even the speed of the entire EV revolution for the next decade. A lot to think about there. Thank you for joining us for this deep dive into the volatile and absolutely critical world of cobalt policy. We'll catch you next time.